Today, I'm joined by Julian Caplin of Hornblower Business Brokers, who specialises in business valuation. Julian has worked with owners across a wide range of sectors on understanding what their business is actually worth and what drives that figure. We're focusing on valuation, because it's often the first question an owner asks, and in many ways, the most misunderstood. What a business is worth on paper and what a buyer will actually pay can be two very different things. From the methods used to arrive at a number, to the factors that push multiples up or pull them down, and where sellers tend to either overestimate or undersell themselves. This is where the process either gets off to a strong start or starts to unravel. So Julian, let's start with this. When an owner asks, what's my business actually worth? How straightforward is that question to answer?
It's never a straightforward question because you need to understand the workings of the business, what creates value in the business, what their balance sheet and profit and loss account looks like, both currently and historically. But ultimately, you have to explain to a possible vendor that the price is going to be what someone is prepared to pay for it. So the way to get into what a potential value might be is to work on the methodology that creates value. So to look at all the elements that you put together to see what an indicative value is for that particular vendor.
Okay, that makes a lot of sense. And really following on from that, what are the main approaches used to value a business? And does the method change depending on who's buying?
So there's probably three main valuation methodologies that you could use in evaluating a business. One is to look at the cash flow. If it's a very heavily cash flow influenced business, that could be more important to a buyer than what's in the balance sheet or the level of profitability, because the cash that's generated is available working capital to grow the business further. You can look at net assets. Net assets is sometimes taken into account when there are significant assets in the balance sheet, and it would be unfair just to look at profitability alone. So if it was a heavily property-based entity, then, or a heavily if there's heavy investment in plant and equipment, you will need to look at the net assets position. But ultimately, most trading businesses are sold on a multiple of EBITDA. So EBITDA is a calculation based on the profitability of the business. It is usually earnings before interest, depreciation, taxation, and it's generally used as it's generally calculated on the normalised basis to see what the normal EBITDA, i.e. profitability, is for that business over either a period of time or in the current year. And what's applied to that is a multiple, and the multiple effectively reflects the investment that the buyer is prepared to make. So if an EBITDA is a fixed number, the multiple can be variable and can apply to different industries in different ways. So certain industries will attract low multiples, certain industries that are in vogue or in demand will attract high multiples, and the multiple is also influenced by the quality of earnings in the company.
I see. And going a bit deeper into the multiple, how much do factors like customer concentration, recurring revenue, or owner dependency move the multiple a buyer is willing to pay?
Yeah, all those things are really important. So if there's a lot of customer concentration, a buyer is going to see that as high risk, because there will be heavy reliance on a small number of customers. And if any of those customers fall out of the business or move after an acquisition, then they're not going to get the return on their investment that they were looking for. Also, they will look at quality of earnings. So how good is the quality of earnings? What type of customers? Are they gilt edge? Are they blue chip? Are they customers that are high risk? And the level of return income then becomes very, very important as well. So if you've got a business that's heavily based on contracted revenue, like maybe some of the IT service companies or those kind of companies, well then they will have recurring revenue, and provided they look after their customers, that revenue is going to recur year after year and will build. So from a buyer's point of view, that's much safer than buying a company where there's very little recurring revenue, and you have to go out to market every year, even though you may be going back to some of the same customers, it's more risky an acquisition. So these things do affect the multiple. The other things that affect the multiple are the particular industries. So certain industries are in vogue from time to time, and there are buyers looking to buy in those industries, and they will pay more for those companies and pay higher multiples. So it's important from our point of view to be on top of the research, to know what sort of multiples are being paid in different industries, so we can advise sellers as to the likely price they could get for their business, all of the things being equal.
I see. That makes a lot of sense. And from your experience, Julian, where do sellers most often come unstuck? Either overestimating the value or leaving money on the table?
Well, it can be either. So preparation is very important. But from our point of view, if, you know, in terms of our clients, we'll spend a lot of time at the beginning of a process going through and helping our sellers understand what the value of their business is. So part of that process will be to determine whether we are on the same page with those sellers in terms of expectation. So we'll be very honest about where we feel the valuation range will lie. And if we find that a seller has expectations that we don't think are achievable, we will tell that seller. And if they insist on going to market, then with those expectations, we would feel that we could just be wasting time, because they're not going to get that sort of price. Now, there's always exceptions to that, and there's always exceptions where certain industries are in great demand and you can get a much higher figure than the multiple. And we'll talk about that with our sellers. We will tell them what the chances and risks are going to market if they're looking for a price that we believe is beyond what a valuation model is indicating. It comes back to what I said earlier, in that the ultimate price is going to be determined by what a buyer is prepared to pay for a particular business.
I see. And finally, if an owner wants to maximize what they achieve, how early do they need to start thinking about this, and what should they focus on first?
So if they start thinking about selling their business, the sooner they start looking at the model, the valuation model, the better, and lead into a situation where they're going into a process. So they should look at maximizing their earnings, because earnings will come through into the EBITDA, which will determine the valuation. They should look at, spreading the risk for a buyer, and just generally tidy up the company in terms of, bad customers, this kind of thing. So the earlier the better, but it doesn't always happen like that, because sometimes an offer will come out of the blue, and sometimes process can move very, very quickly. In some industries that are particularly in demand, there are buyers out there hunting for companies, and they will want to move quite quickly. So in those kind of situations, the seller doesn't have a chance to prepare his company, and it's our job then to try and negotiate with the buyer and let them understand what the real profitability of the company is without having had the opportunity to build up to that level of profitability. So that's where it becomes important to understand the business and to explain to the buyers that they haven't prepared themselves for sale, and be able to present the figures on a basis that would be more consistent with a situation had they prepared for sale. Okay. Now, a buyer is not always going to accept that, because they will accept they may say, well, the company is where it is, and it's for us to make the synergies, or to tidy up the company, or to get the growth. And that's where the negotiation process starts.
I understand. Great. Well, thank you very much for sharing your insight and joining us today. I really appreciate it, and I'm sure our listeners will find that really useful.
Great. Thank you. You're very welcome.